Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of bond yields, the key to profitable investing in a volatile market. Bond yield plays a crucial role in the world of investments, influencing the decisions of both novice and seasoned investors. Understanding bond yield is fundamental to making informed investment choices. Essentially, bond yield refers to the return an investor can expect from a bond, taking into account its interest payments and market price fluctuations. For beginners, grasping the concept of bond yield is a stepping stone to building a profitable investment portfolio. It serves as a key metric to assess the performance and potential risks of bonds. Experienced investors, on the other hand, rely on bond yield to optimize their investment strategies, seeking higher returns while managing risks effectively. By looking into the intricacies of bond yield, investors can make strategic decisions tailored to their financial goals and risk tolerance levels. Whether you are just starting your investment journey or looking to fine-tune your portfolio, a solid understanding of bond yield is essential in navigating the dynamic landscape of financial markets. Understanding bond yields. When delving into the realm of bond investments, understanding bond yields is pivotal for making informed decisions. Bond yields represent the return an investor can expect to receive from a bond. They are crucial metrics for evaluating the profitability of a bond investment. Let's explore the key types of bond yields and how they impact investment decisions. Current yield. The current yield of a bond is a simple yet essential metric used to assess the return on investment. It is calculated by dividing the bond's annual interest payment by its current market price. For example, if a bond has a face value of $1,000, pays $50 in annual interest, and is currently priced at $950, the current yield would be 5.26%, $50 per $950. While current yield provides a snapshot of the immediate return on a bond, it has limitations. It does not consider fluctuations in the bond's price or the time value of money. Investors should supplement their analysis with more comprehensive metrics like yield to maturity, YTM, and yield to call, YTC. Yield to maturity, YTM. Yield to maturity, YTM, is a crucial measure that factors in the bond's price, coupon payments, and time to maturity. YTM represents the total return an investor can expect to receive if the bond is held until maturity. It considers both the annual interest payments and any capital gains or losses upon maturity. Calculating YTM involves solving for the discount rate that equates the present value of the bond's future cash flows to its current market price. Investors use YTM to compare the attractiveness of different bond investments. A higher YTM indicates a potentially higher return but also higher risk. Yield to call, YTC. Yield to call, YTC, is similar to YTM but focuses on the return if the bond is called by the issuer before reaching maturity. Bonds often have call provisions that allow the issuer to redeem the bond early. YTC considers the bond's potential lifespan until the call date and the call price. YTC becomes relevant when assessing bonds likely to be called, impacting the investor's potential returns and risks. Understanding YTC helps investors make informed decisions based on potential call scenarios and their impact on overall returns. In the dynamic world of bond investments, grasping the nuances of different bond yields is essential for building a resilient and diversified investment portfolio. By evaluating current yield, YTM, and YTC, investors can make informed decisions that align with their investment goals and risk tolerance. Factors influencing bond yields. Exploring the key components that impact bond yields provides valuable insights for investors seeking to navigate the intricate world of fixed income securities. Understanding the factors driving bond yields can enhance investment decision-making and optimize portfolio performance. Let's delve into the critical elements influencing bond yields. Interest rates and bond yields. Interest rates play a fundamental role in determining bond yields. There exists an inverse relationship between bond prices and interest rates. When interest rates rise, bond prices tend to fall, and vice versa. This phenomenon, known as interest rate risk, poses a significant consideration for bond investors. As interest rates fluctuate, the value of existing bonds can experience volatility, impacting overall investment returns. Bond investors must carefully assess interest rate movements to manage risk effectively and maximize yield potential. Credit quality and yield spreads. Credit quality stands as a pivotal factor influencing bond yields. It refers to the creditworthiness of bond issuers, reflecting the likelihood of timely interest and principal repayments. Bonds issued by entities with higher credit ratings typically offer lower yields compared to bonds with lower credit ratings due to the higher credit risk associated with the latter. Yield spreads, the variance in yields between different bond categories, serve as a barometer of credit risk in bond investments. Understanding credit quality and yield spreads is essential for investors to gauge the level of risk and return associated with their bond holdings. Maturity length and yield curve. The maturity length of a bond is another determinant of bond yields. Generally, longer maturity bonds tend to offer higher yields compared to shorter maturity bonds to compensate investors for the extended duration of their investment. The yield curve, a graphical representation of yields across different maturities, provides valuable insights into the prevailing interest rate environment and economic conditions. Various shapes of the yield curve, such as normal, inverted, and flat, convey vital information about market expectations, inflation trends, and overall economic health. Analyzing the yield curve empowers investors to make informed decisions regarding bond allocations and portfolio positioning in response to changing market dynamics. By comprehensively evaluating the factors influencing bond yields, investors can adopt a strategic approach to bond investing, mitigating risks and capitalizing on opportunities in the dynamic fixed income market landscape. Navigating the nuances of interest rates, credit quality, maturity length, and yield curves equips investors with the knowledge and confidence to optimize their bond portfolios and achieve their investment objectives effectively. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.